Hey guys, Cameron here with Emerson Property Management. Every week I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable rental portfolio in about 2 years and now manage that portfolio. Today, guys, I want to talk about why rentals suck. So most property management companies are going to tell you about all the great things of rentals, why rentals are fantastic, why you should continue to buy rentals and keep them under management for that management company. However, having owned rentals for almost a decade now, I can tell you that there are things that make them difficult. There are people that should not buy rental property. If you don't have the stomach for certain things, you shouldn't do it. While it might be a fantastic idea, it just doesn't work for you. So I just want to cover a few of those things. So I'm just going to go out throughout this episode. I'm just going to cover a handful of reasons on why rental properties suck. They're not fun all the time. It can be a great wealth generator. I have plenty of other videos on why they're fantastic. But I can tell you, I just want to go over why they're not and what you can or can't do about it. And then you can make your own decision on whether you think it's a good move for you or not. So I've got a list of 4 things why rentals suck. They're illiquid, they're inconsistent, they're immobile, and they're not immediate. I couldn't think of another I word. So illiquid, the first thing, what does that mean? If I buy a stock, or I have cash in the bank, I can sell that stock Monday through Friday, as long as it's not a holiday, and it will hit my bank account in a couple days or settle into the brokerage, Vanguard account, whatever you have, in a few days. Same thing with cash, Bitcoin. I'm not a big fan of Bitcoin. I've got a video up here on that. That's still applicable today. But it's not liquid, meaning you can't just sell it or trade it for dollars, for US dollars. You got to wait. And by wait, I mean get the property marketed, whether that's with a tenant in place or not. You're going to get a higher price if the tenant's out of place or vacated. You get the property fixed up, then you get it listed, then you get it sold, and then you got to wait till closing comes. So that process takes 30 to 60 days. And now we're coming out of that hot market where all the sellers got spoiled because you could list your house on a Friday and it'd be sold on a Saturday and close in a week or two. That stuff's gone, at least for the foreseeable future. Interest rates are up and whatnot. And I would never bet on that. There is a huge business out there, some of you may or may not have heard, of wholesaling. Now that happens predominantly, there are other situations, but predominantly wholesalers make money because they're solving a liquidity problem for the rental owner. Now, what does that mean, Cameron? That sounds like a big word. Liquidity just means that they need cash. That owner needs cash. That property owner needs some money. And this is not a liquid investment, meaning I can't just get it out right away. So I go to a wholesaler who says, I'll give you cash in 10 days or 3 days or whatever. And they take a significant discount to the value because you just need that cash right now. And guys, I know you think this isn't a big deal. I put it number 1 because why do you think wholesalers make so much money? The first thing they tell you when you guys go to any seminar on buying properties off market at a discount, the first thing they tell you is out-of-state landlords. They talk about mailing to owners who've had property for a while, mailing to eviction lists, mailing to probate. These people want the cash now. They don't want to mess with it. Or they're out of state and they're not paying attention, whatever it is. The liquidity problem of rentals can put you in a pinch. So, what can you do to solve the liquidity problem or the illiquidness of the rental properties? Is you can make sure you have some reserves. Make sure you're setting aside money. Make sure that you're investing from a place of strength. I did a lot of burr investing. I got a video on that up here around picking up rental properties. And I did that a lot early on. But I had cash. I had a good job. So make sure you have some cash sitting on the sidelines. Make sure that you don't become one of those owners that gets targeted by a wholesaler and you have to sell your $200,000 piece of property for $100,000. Make sure you have that. So illiquidity of real estate is one reason why rentals suck. The next one is inconsistent. So the inconsistency of cash flow. It goes like this. When you buy a property, you're going to have to fix it up. That could be $5,000. That could be 10. It could be 50. It could be 100, 150, depending upon what part of the country you're in. So you're going to have to put some money into it initially. Even if you have a tenant in place, as soon as they move out, you're going to have a turnover. Now, people might think, hey, I'm going to make $300, $400, $500 a month on this property. So you have a leak. You got to replace a roof. You have a storm. You have a pipe freeze, which we've had a lot of over the past 2 years here in Houston. Something will come up. We average 2 to 3 maintenance requests a year per property. That I've heard is on the low side, but we do a very rigorous job on the front end to make sure that we're not, that we take care of stuff when a tenant moves in. So maybe 3 to 5, you could say, if you're an average Joe or Jane. And if it's an older property, it's probably closer to the 5 or 6. So you've got to be careful if you're going to take your cash flow and think that because it says on my pro forma that I'm going to make $300 a month, and you think, okay, I need that. That $300 a month might be $600 one month, might be negative $500 the next month. The hot water tank goes out. Again, I can think of 1,000 different examples, and it just goes like this. Your cash flow goes like this. So if you're older, or you really like the fact that you can put money in the stock market and draw 4% off of it, that is not this type of investment. Now, if you have a lot of properties, you will see those, they kind of, one property will be up one month, one will be down, and they'll kind of go back and forth. So it might kind of average out if you have a larger portfolio, but especially if just 2 or 3 properties, you cannot guarantee on that income. A lease fee, when you do a turnover, you've got rekeying between the tenants. There's all sorts of different things that make this an inconsistent investment. So inconsistency is another thing that makes rental properties suck. I would love just to collect $400 a month per property and that be it. But it doesn't happen like that. So again, make sure you have some cash reserves. Make sure that you're factoring that in, especially if you have some CapEx, capital expenditures, like larger items that are going to come down the pipeline. Make sure you're taking care of those. The next thing that makes rentals suck is they're immobile. So what does that mean? That means that if the neighborhood goes to shit, I can't pick my house up and move it. Let's just say one town or one area is doing fantastic. There's Amazon's putting in an office, jobs are moving there. There's a certain political group in that area that's doing something and people are moving in or moving out. You can't move your house to the neighboring city. If they're going to put a Walmart in next door, maybe that drives property values down. You can't pick that property up and move it. So there are areas, especially, it's happened all the time here in Houston with all this development. There are areas, especially east downtown. I live over here in the east side. There's a huge $400 or $500 million development going on in here. Property values are flying up, but 10 years ago they were terrible. And you add different things in that can create demand or drive demand out. So whereas in anything else, stocks, bonds, gold, you can take your money and just transfer it to another stock, transfer it to another bond, transfer it to, sell it immediately and move it into something else. You can't move your piece of real estate. If you got a mobile home, sure. But you for 99% of the people watching this, you cannot move your real estate. Which makes it, if you guys got a great piece of property, that makes it awesome. But what happens when, like Florida or Houston, when we had Hurricane Harvey, you can't pick your property up and move it up to higher ground so it doesn't flood. You can't get it out of the way of a hurricane. So when you buy in stocks and bonds, and this video isn't intended just to push you into stocks and bonds and get you out of real estate, but I just want you to understand that when you buy a piece of real estate in a certain property or province or city or whatever it is, it's there. You're hoping that around you is going to do well, or the city or the county or township is going to put money into that to help those values go up. So make sure you understand that. There's a lot of thoughts on this, on how much appreciation plays into your calculations. For my portfolio over the past decade, and I think it would be for a lot of people, but I think this is historically true, the majority of your returns are going to come out of your appreciation. So make sure, and good areas appreciate better than poor. I say poor, not like economically, but just less demanding areas, the areas that don't have as much economic growth and jobs moving in. So remember, immobile, that's a bad thing. It can be a great thing, but a majority of the time it's a bad thing. Not immediate. So again, I couldn't think of another I word. So it's not immediate. Guys, talked about this a lot. And if you plan to buy a rental property and think that you're going to make bukus of money, tens or hundreds of thousands of dollars in a year or two, you are sorely mistaken. If you even think that your first year you're going to make $200 or $300, I would guarantee that you don't. I would almost lay money you're not going to. Something's going to come up, especially as a new person in rental property investing. Things come up. Vacancies take longer. Rehabs take a little bit longer. Contractors walk out. So many things can happen. And 1 month of vacancy is about 8.3% of your gross annual rents. So if you thought you were going to make a 15% return and that property sits vacant for another month than you anticipated, now you're at a 7% return. If it sits vacant 2 months, you're at negative. You've lost money that year. So understand that real estate is not immediate. If you're flipping, that's different. I'm not a big flipper. I don't like flipping. I've done it. I'm not a big fan of it. I think the true wealth generation is in long-term rentals. But you have to understand and make decisions. I've got another video on it. I can't remember what it's called exactly, but you have to look at it in the long term. Because if you're thinking that you're going to make so much money off this in year 1, 2, 3, you're going to make different decisions than if you think you're going to keep this property for 10, 15, 20 years. You're going to put a little bit more work into it up front. When you have improvements and, do I want something that's going to last a year or want something that's going to last the next 10, 15, 20 years? You're going to make those decisions and your future self will love you. Because as rents could go up with inflation, your mortgage should stay relatively the same and the property value should go up as well. So you'll get that, the cash flow, the tax benefits, but those don't happen overnight. I have had many properties that I purchased that made $100, $200 a month that at that time, a snapshot in time, you would have said, why even mess with it for that? Well, now, 5, 7, 10 years later, those properties make $500 to $700 a month. Now they're worth it. And all I had to do was wait. So they're not immediate. Okay, again, I love rental properties. I'm a big proponent of that, but I don't think this is talked about enough. I don't think people understand that they're illiquid. You're not going to be able to pull your money out whenever you want. They're inconsistent. 1 month you might make $500. Next month you might lose $5,000. Eviction, God knows what. They're immobile. If an area is starting to lose allure and desire and jobs are moving out, you can't pick up and move your house. You got to ride it out or sell it. And it's not immediate. Guys, don't think you're going to make a baby in 1 month by getting 9 women pregnant. This is one of the most underrated things I see new investors making. Play at least 5 years. If you make money before 5 years, owner of property before 5 years, I would love to see it. That would be awesome. But plan 5 years and beyond is where you want to start making your money. And I think you'll find that rental properties are a fantastic investment from there on out. So I hope that was helpful. If it was, let me know. If it wasn't, let me know. And I appreciate y'all.